Something unusual is happening in the silver market. Stop scrolling, pause whatever you're doing, and watch this through to the end. For decades, a small number of major financial institutions have played an outsized role in the precious metals market through systems most everyday investors rarely see. Paper contracts, derivatives, and complex hedging strategies dominate trading volume, often far exceeding the amount of physical metal available in the real world. This structure has allowed price discovery to be driven largely by financial instruments rather than physical supply and demand, an arrangement that affects miners, manufacturers, and investors across the globe. Recently, however, signs of stress have begun to surface. Physical silver premiums have risen sharply. Requests for delivery at major exchanges have increased, and market participants have started questioning whether existing supply mechanisms can continue operating smoothly under growing demand pressure. This is the story of how silver arrived at a critical moment, why the coming year could be pivotal for precious metals, and what many experienced observers are watching closely. To understand where silver may be headed, it helps to understand how today's market structure developed. Silver trades in two interconnected markets. One is the physical market, where actual metal moves between miners, refiners, industrial users, and investors. The other is the paper market, where futures contracts, options, and other financial instruments trade in volumes many times larger than annual global production. On a typical trading day, paper silver volume can represent multiple years' worth of mined supply. Most of these contracts are settled in cash rather than physical delivery, meaning price movements can occur without metal ever changing hands. This is not hidden or secret. It is the standard design of modern commodity markets. Critics argue that this structure can sometimes disconnect price signals from physical availability, especially during periods of tight supply. Regulatory actions over the past decade have highlighted instances where individual traders at large banks engaged in improper trading practices, resulting in significant fines and settlements. While penalties were imposed and compliance systems strengthened, concerns about market transparency have continued to circulate among investors. The challenge facing the silver market today is rooted in simple math. Global silver production has remained relatively stable at around 800 million ounces per year. Growth has been limited because most silver is produced as a byproduct of mining other metals, such as copper, zinc, lead, and gold. This makes rapid supply expansion difficult, regardless of price movements. At the same time, industrial demand is growing steadily. Solar energy alone requires substantial amounts of silver, with each gigawatt of capacity consuming millions of ounces. As renewable energy deployment accelerates worldwide, silver usage continues to rise. Electric vehicles add further demand. Each EV uses silver in electrical systems and power components. As global EV production expands into the tens of millions annually, consumption increases accordingly. Silver is also essential in electronics, medical equipment, water treatment, and advanced technologies, applications where substitution is often limited due to its unique conductive properties. When industrial demand is combined with investor interest, the market begins to rely more heavily on existing above-ground inventories. Those inventories, while significant, are finite. The gap between quoted prices and real-world purchasing costs has drawn attention. Many retail buyers have noticed that acquiring physical silver often requires paying well above the quoted spot price. Premiums on coins and bars have risen compared to historical norms, reflecting supply chain costs, fabrication demand, and market sentiment. Whether these pressures ease or intensify will depend on production trends, industrial growth, investor behavior, and broader economic conditions. One thing is clear: the silver market is entering a period that deserves close attention. This premium represents a market signal. It tells you that buyers with actual money who want actual metal do not believe the paper price reflects reality. They are willing to pay substantially more than the futures market claims silver is worth, because they understand that the futures market is increasingly detached from physical supply constraints. The major exchanges have responded by tightening delivery standards and increasing margin requirements. These measures are designed to discourage delivery demands and keep the paper game functioning. But they also reveal the underlying fragility. When an exchange must actively discourage participants from claiming the physical commodity that contracts theoretically represent, something fundamental has broken. Industry insiders report that registered silver inventories at major vaults have declined to their lowest levels in years. The metal that supposedly backs all those paper contracts is draining away as industrial users and determined investors pull physical ounces out of the system. The macroeconomic backdrop makes silver's supply constraints even more consequential. The Federal Reserve spent 2 years fighting inflation through aggressive rate hikes, but the underlying monetary expansion of the pandemic era cannot be undone through interest rate policy alone. The United States added more than $8 trillion to its money supply between 2020 and 2023. Those dollars still circulate through the global economy, and they still seek stores of value that cannot be printed into existence. Gold has responded to this monetary reality by reaching historic highs. Central banks, particularly in non-Western nations, have accumulated gold reserves at the fastest pace since the 1960s. China, Russia, India, and their BRICS allies have made clear through their actions that they are preparing for a world where the dollar's reserve currency status is no longer guaranteed. Silver typically follows gold with a lag, but when it moves faster and farther. The gold-to-silver ratio currently sits near historic extremes, suggesting that silver remains dramatically undervalued relative to its monetary cousin. If the ratio merely reverts to its historical average, silver would need to nearly triple from current levels with gold unchanged. But gold is not unchanged. Gold is climbing because the same nations accumulating gold are also quietly stockpiling silver. Chinese silver imports have surged in recent years, with hundreds of millions of ounces flowing into the country and never returning to Western markets. India's silver demand has shattered records as citizens seek protection from rupee volatility. These are not speculative positions. They are strategic acquisitions by nations and populations that remember what currency debasement looks like. The institutions holding short positions face an increasingly impossible situation. When you are short a physical commodity, you are betting that you can either push the price down or acquire the underlying asset more cheaply in the future. Both options are closing for silver shorts. Price suppression requires a constant supply of paper selling pressure. But that selling pressure must eventually be absorbed by someone willing to take the other side of the trade. As more participants recognize the fundamental supply deficit, fewer are willing to bet against silver. The shorts must work harder and deploy more capital to achieve the same suppressive effect. Meanwhile, acquiring physical silver to cover short positions has become dramatically more expensive and difficult. The metal is in high demand for legitimate industrial purposes. Investment buyers are holding their positions rather than selling. And foreign central banks are not interested in parting with strategic reserves to help Western financial institutions exit bad trades. The fear among shorts is what traders call a delivery crisis, a scenario where too many contract holders demand physical metal simultaneously, and the shorts cannot provide it. In such situations, prices do not rise gradually. They gap higher as panicked shorts bid against each other for whatever physical supply exists. We have seen this dynamic play out in other commodities. The London Metal Exchange nickel crisis of 2022 demonstrated what happens when shorts are trapped in a delivery squeeze. Prices doubled in hours, trades were cancelled retroactively, and the exchange's credibility was permanently damaged. A similar event in silver would have far broader implications given the metal's monetary history and investment appeal. Regulatory attention adds another dimension of pressure. The Commodity Futures Trading Commission has faced years of criticism for its permissive stance toward concentrated short positions in precious metals. Lawsuits and public advocacy campaigns have demanded enforcement of position limits designed to prevent any single institution from dominating a market. While the CFTC moves slowly, there are signs that regulatory scrutiny is intensifying. Concentrated positions that were tolerated for years may face new requirements for transparency and reduction. Any regulatory action that forces major shorts to cover, even partially, would accelerate the price dynamics already in motion. The shorts understand this risk. Internal risk management at major institutions surely models scenarios where regulatory intervention forces position reduction within compressed timeframes. Such scenarios do not produce gradual price adjustments. They produce spikes that transform orderly markets into chaotic scrambles for limited supply. Geopolitical realignment amplifies every trend affecting silver. The BRICS nations, Brazil, Russia, India, China, and South Africa, have made de-dollarization a stated policy objective. While creating an alternative reserve currency remains a distant goal, accumulating hard assets that maintain value regardless of dollar dynamics is an immediate strategy. Saudi Arabia's evolving relationship with China and its willingness to consider non-dollar oil settlements represents perhaps the most significant shift in the global monetary order since the original petrodollar agreement of the 1970s. If oil begins trading in alternative currencies, the structural demand for dollars that has supported American monetary policy for 50 years begins to erode. In such an environment, commodities like silver become more than industrial inputs or investment vehicles. They become strategic assets in a global competition for resources and monetary sovereignty. Nations that accumulated silver at $30 will look prescient if silver trades at $300. Nations that dismissed precious metals as barbarous relics may find their currency reserves evaporating through inflation and depreciation. What should thoughtful investors conclude from this analysis? First, that the silver market's structural dynamics favor higher prices over the medium term. Supply constraints are real and not easily resolved. Demand growth is accelerating across multiple categories, and the paper market's ability to suppress prices is eroding as physical premiums signal widespread distrust of official pricing. Second, that volatility will be extreme. The forces that have suppressed silver prices for years will not surrender quietly. Expect sharp corrections, discouraging narratives, and moments of genuine fear. The path to higher prices runs through maximum uncertainty. Third, that physical ownership matters. Paper claims on silver, whether through futures, ETFs, or unallocated accounts, carry counterparty risk that physical metal in your possession does not. If the distinction between paper and physical markets widens, those holding paper may discover that their claims cannot be easily converted to metal. Fourth, that patience will be rewarded. The institutions on the wrong side of this trade have resources to delay the reckoning. They will use every tool available to shake out weak hands before covering their positions. Those who understand the fundamental picture and maintain conviction through volatility will be positioned to benefit when the market finally reprices to reflect physical reality. The silver market stands at an inflection point that arrives perhaps once per generation. Decades of manipulation, structural supply deficits, accelerating industrial demand, monetary debasement, and geopolitical realignment are converging on a market that remains remarkably small by global financial standards. All the silver mined in human history would fit in a cube less than 60 feet on each side. The total value of silver held for investment is a rounding error compared to global stock and bond markets. This small market is about to absorb demand from renewable energy, from electric vehicles, from nations seeking alternatives to dollar hegemony, and from institutions forced to cover positions accumulated during decades of complacency. The arithmetic does not lie. The shorts know it. The question is not whether silver will reprice, but when and how violent the adjustment will be. Those who position themselves correctly before the resolution will witness one of the most significant wealth transfers of the modern era. Those who dismiss the evidence and cling to paper prices that diverge ever further from physical reality may watch their confidence evaporate along with their purchasing power. The reckoning is coming. The only uncertainty is the date.